So there may come a time where it doesn't make any sense anymore to remain as a sole trader for your business. And you need to make that transition from being a sole trader to setting up a limited company and transferring all those business assets from your sole trader business over to your limited company. And in this video, I'm going to talk about when might be the right time to do that, as well as all the steps that you will need to take and some of the tax issues that you might face along the way. So if that sounds like it could be some useful information for you, then make sure to stick around till the end. So first off, let's cover off some basics. Every euro of profit that you make as a sole trader is going to be taxed to the full hilt of income tax, PRSI and USC. So even if you don't take that profit out of the business as such and use it for your day-to-day living expenses, it's still going to be taxed. In that way, it is far more difficult to build business wealth as a sole trader. If we compare that then to, say, a limited company, you'll pay a low corporation tax rate of 12.5% on all profits. Then you will pay income taxes only on the dividends or the salary that you take from the company. But the key point here is that the profits that are retained by the company are not taxed any further than the 12.5% corporation tax. That's once you're not a close company in receipt of, say, passive income such as rent. If you are in receipt of that kind of income in your limited company, then you may have to pay a close company surcharge on top of the corporation tax rate of 12.5%. But you don't need to worry about that if your business is just generating trading profit. So when does it actually make sense to incorporate? Well, the income tax rates start to get pretty high in Ireland once you start earning more than, say, €40,000. Your marginal rate of tax once you earn more than €40,000 goes up to 48.5%. So that is the tax on every euro that you earn more than €40,000. That further increases then to 52% at 70k and to 55% for sole traders at 100k or more. So it becomes a good time to start evaluating your business when the profits generated by the sole trader business is covering well in excess of what you need to cover your day-to-day living expenses. At that point, it may start to become more attractive to transferring your business from being a sole trader to a limited company. One issue though that you could face is when you transfer your business to a limited company, that limited company is basically like a new person that you're transferring your assets to another person. So it's like a capital gains tax event is kind of triggered in that scenario. So you could potentially have to pay capital gains tax. And for, say, a sole trader who has a property that maybe has appreciated a lot over the last couple of years, then that would obviously be quite a big capital gains tax bill to have to pay just for kind of an administrative change to their business. But thankfully, there is a way that you can defer some or all of the capital gains tax that will be triggered by this kind of business change. And we're going to go through that now in the next few slides. Under Section 600 of the Taxes and Consolidation Act 1997, there is a provision for you to defer some or all of the capital gain, as I was saying, when you transfer from being a sole trader to a limited company. So the main condition that you will need to meet here to avail of the CGT deferral is to transfer every business asset from the sole trader business to the limited company. You cannot just pick and choose certain assets that you want to transfer from your sole trader business to your limited company to get the full deferral of CGT. You need to transfer all of the assets. Another important condition of getting the full CGT deferral is that the only thing that you should receive when you transfer your assets from your sole trader business to your limited company should just be shares in the limited company. So you're now the owner of the limited company, but if you're receiving some other sort of consideration, say a cash payment on top of the shares that you're receiving, then you won't get the full CGT deferral in that case. So if there's any other consideration aside from the shares in the company, then that capital gain will have to be apportioned. So you'll only get a kind of a partial CGT deferral and you'll have to pay capital gains tax pretty much immediately on the portion that is related to the cash payment. So that's just something to be careful with and to talk fully through with your accountant before you kind of pull the trigger on anything. So how does this deferral actually work? So in the future, when and if you actually sell the shares of this new limited company, what you'll need to do then is deduct the original gain that you made at the time when you transferred your business assets from being the sole trader to the limited company from your CGT calculation in the future when you're selling your shares of that limited company. So that's why it's not really a CGT relief, it's just a deferral of paying that capital gains tax into the future. But at that time in the future, when you are selling your shares in the limited company, you will have other reliefs at your disposal to try and limit your CGT exposure, such as, say, retirement relief and entrepreneur relief as well. Lastly, let's go through some of the steps that you will need to follow in order to make that full transition from being a sole trader to a limited company. Even when you are still operating as a sole trader, you can go ahead and start registering your limited company, because that's probably going to take 2 or 3 weeks before you get everything set up in terms of registering the limited company with the CRO and also registering the company for tax with the Revenue Commissioner. Also, you're going to have to open up a new bank account as well, which is going to take a little bit of time. That bank account is going to have to be in the name of the limited company and not your kind of sole trader business. So you're going to need a completely new bank account. As we said already, you're going to need to transfer all of the assets, including the goodwill, etc., to the new limited company in order to get your full CGT deferral into the future. And also then, once that is completed, you will have to cease the trade of the sole trader business. The timing of this is obviously going to be very important, because you don't want to leave yourself with any kind of gaps where you can't trade or anything like that, or a situation where your sole trader business is still receiving lots of different say business transactions when you have your assets actually transferred over to your new limited company. So that is going to be something that has to be kind of carefully managed. And even though you are ceasing the trade of your sole trader business, you're still going to have to remain registered for income tax yourself, because most likely you are going to be a director of this new limited company, and all directors have to be registered for income tax also. So you'll still be completing your Form 11s every year like normal. And lastly, you're going to have to prepare the capital gains tax return to take account of the whole transfer of business assets from yourself to the limited company. And another thing that I should have put down here as well is there's a transfer of business relief in terms of you don't have to charge VAT on, say, the sale of, say, your sole trader business to your limited company. So check that one out as well. There's a few different conditions that you need to meet to use that transfer of business relief as well. But that's another important one to be aware of. And that's pretty much it for this video. If you found this one useful, check out some of the last few videos. They're all business related content on my channel. And if you have any other suggestions or anything else that you would like to see me cover on the channel, please let me know in the comment section as well.